So let's move on and kind of get into really the next part of the program, which is behavior and really what gets in your way from having what it is that you really want. So here we are. Everything starts with a goal, right? I mean, that's pretty common, but why do a lot of goals go by unaccomplished? I mean, how many people set something out on the beginning of the year to lose weight or spend more time with family or just do various things, and they just don't do it? It's the canceled dream. So what's going on? What's happening? What's in the DNA that doesn't make this happen? Well, maybe it's values. You're not aligned with your values, but I don't think that works either. I don't think that's working. I think values don't work either. Goals don't work and values don't work. That's pretty brutal to say. Well, why is that? Let me ask you this. Let's say you grow up and this is your next door neighbor's dog, and they're fierce and they torment you throughout your childhood. And then when you get married and you have a kid, and your 5-year-old son comes home and says, "Dad, I want a puppy." What do you think you're going to say? You're going to say, absolutely not. You might have a cat, but you're not going to buy a dog. Absolutely, because you've got this experience that's driving your process. What about you grew up in this environment? Oh my God. Your son comes home and says, "Dad, let's have a dog." You're like, "Oh, let's get a couple of them. You know, let's get a matching set." So this is what happens. This is what occurs for us. So what is really 2020 going to be like? It's probably going to be the same as the last year or the year before or the year before, until you figure out what's going on kind of inside it. Look at what Buffett says about the chains of habits and why we tend to keep doing the same thing. So you got to figure out your code. You got to figure out what is driving you, and it's typically some element of your past that operates underneath the surface. It's like your operational code. I had a real world experience recently with a client that I've been doing business with 20 years. Met her in this class. She drank herself to death. She's dead. It's tragic. Her body shut down. Her goals were not to drink herself to death. As we embarked in her plan, her family sold a big business. She got a massive amount of money. She was absolutely financially set. But she decided to take that path. The irony is her mom took that same path. Much later, much older, but the same path. So I scratched my head, and so I'm super focused on what it is that people need to understand about their past and their behavior and their experiences, because if you don't deal with that, you may say that you want all these various things in your life, but you're going to do something very completely different. And how you know that is look back on things that you want that you're not doing. That's the clue in all of this. So you got to understand the behavior. You got to understand, all of this. And this is the effect, if you can put up the slide full screen, is just the kind of the cycle, whether the behavior is positive or negative. In our past, it's going to determine a lot of different things and how we deal with it. So that's all the things that happen behind the scenes. It's all the things that happen in and around. So the question is how many times have you had a goal that you've just tried and it just, it hasn't worked? So we got to take a look back. And so how do you do that? Well, 12-step groups are amazing to do that. And there's a lot of programs and organizations that really help you to go back through there. I love the thing about the 12-step groups, and I'm in that. I've been clean and sober in AA for north of 30 years. And what AA does and what 12-step groups is they have you go back and they say you can't recover unless you clean up the past and you face the past and you deal with it. So therefore you can move on. So all of us need to kind of go back and look at those things and look at those traumas and those things in our world that we're either burying, or either we're keeping a secret, we're not dealing with, we're medicating it in money or gambling or any kind of addiction, because money can be that for people. I see it. I see people that are consumed with money and consumed with a new thing that they think is going to make them feel better, and it just doesn't. It's another thing. And a lot of times we don't want to do this. We're comfortable in the what is. I work very, very hard in my personal development. I'm always looking for, how am I communicating? What am I discovering? I had a failed marriage. I'm engaged to an amazing, amazing person. And I don't want to screw that up. And so if I bring the same old Walter to the same old equation, it's probable that I'm going to probably get the same result. So you really got to shake it up and you got to ask yourself, what are you willing to do in and around your ability to be different and create something new? Because that future, it's very predictable. You just got to look at the past and see what you did to know where you're going. And don't fool yourself that it's going to be different. Like you've tried to be different and it hasn't worked. And so then what do we do? It's like, look at this dog. He's like, I ain't going. So we look at what's working and we start asking ourselves questions. Are you happy? Are you fulfilled? What do you want your future to be? Deal with your past. Deal with those demons. Deals with those messages that play out. Mine was all about winning. I learned very early age that when you won a trophy, you got accolades. If you didn't win, you weren't noticed. I started competing when I was 5 years old. I was a water ski racer. When I was winning, everybody knew me. I couldn't believe it. I'm like, I don't know you. How do you know me? And then when I was losing, nobody cared. And so it became about winning. It drove me. I had to prove something. I had to realize that. I had to get some clarity around that. I had to see it for what it is. Get some peace. Then, and only then, once you deal with that, you wipe the slate clean, then you can really get into values. You can really feel like what's important to you. You start out with something new. So we move into the whole value process, and I think people in this area got to be careful. Values are 3 or 4 core things that you're very committed to. Go back to this Southwest slide. It's like the heart. It's like this is who we are. Sometimes people memorialize values and put 10, 15, 20 things, and it's just a bunch of words on a piece of paper. Permission to play values are values that are like honesty and love and things that are just a given. You got to have these in order to even be a human being. And then you've got these accidental values that are aspirational values that are really things that you aspire to but are not you. Got to be realistic about what it is. Like we may aspire to be a world changer like Ellen or President Barack Obama or Melanie Walton. That's maybe not us today. Then you've got these accidental values, scenarios that you kind of get into that just happen by virtue of habit, not because you really set out to do them. So really what's next? You get out a piece of paper and you do a value exercise. And you really write down the 3 or 4 things that you're committed to. Like what is it around the key things that are ultimately super important to you? And you refine. which ones are somewhat important, which ones are rarely important, or which ones are critical. And then that begins to develop your why. So you have some super clear direction on where you're headed and what you're doing. Simon Sinek's book, Start With Why, I think is amazing because so many people think about the what. In this program, people come in and say, I got $5 million, $10 million, $30 million. Here's what I need to do. How do I generate this amount of income? And then they move in versus, okay, what's the driver? What's ultimately important? And once you have those core things done, you can really do goal setting in a very dynamic way and take on the big stuff, take on the challenges. So here's what I'd like you to look at, and here's a little bit of an exercise around what I call the wealth circle. So you basically have 4 areas. You've got family wealth, physical wealth, business wealth, and community wealth. Tyler, can we get my iPad launched up? So you know that I'm not an artist, but we draw these circles, and so they're in the middle. And what I'd like you to do is take out a piece of paper, and this is 1 is the center, and this is 10. Like I've really got this wired. It's a similar analysis that what you did before. And so what you're really looking for is what areas of your life need attention. And so first look at family. So family first. Then we look at personal health. And we rate that 1 to 10. So you would draw a dot. So if family's really good, you'd say, okay, I'm right here. And then physical health, I exercise all the time, doing really well. Community is about a 5. And then business is a 6. So you kind of you draw your own circle, kind of given where you're at, and kind of see where you're at. And this is just a guide, and it's an assessment. You look at yourself and say, okay, how am I doing? What areas, as I move this ball forward relative to my values and my mission, do I need to improve or alter? So many people have amazing businesses. They have a 10. I'm crushing it in my business, but I draw the circle again. I'm crushing it in my business, but my family's suffering. And then my health, oh my God, I got high blood pressure, I'm overweight, I got a lot of money, but the longevity and the quality of my life is good, and I'm a huge giver in the community. So that's what my wheel looks like. So these are things that we look at, and because we just can't have it all, something's got to give in terms of what our experience is. And so as we move in to this, we really look at what's my true purpose for money, and where am I headed, and how are the 4 quadrants, and how are they going to exist? So this really can happen. This really can happen in a very significant way. So let's talk about what are the enemies of the plan. So you have all this, you're fired up, and again we get into this emotional state. Handling our emotions, handling optimism, looking at how we're doing things and what we need to be doing. So once we handle behavior and we have systems, we then can move into where the capital markets are and looking at the different investments and ultimately how we're going to allocate it. So we'll sit down, we'll do these analysis around the values and the wheel. and we handle emotions, and we're really set up for success. So now what I'm going to do is I'm going to segue into our next section, which is just market returns. So this is just a overview, kind of a broad overview of how capital markets work and the key things that you need to think about relative to just simple investments in stocks and bonds. And we will expand those categories in next week's program. So when we look at the two vehicles that we have a choice of, we got stocks, bonds, and cash. We first look at bonds, and we know that, you know, real bonds are, we're a lender. We're loaning money to somebody for the right to get our money back at a certain time, and for that we get a level of interest rate. There's different types of them. There's government bonds, there's corporate bonds, there's money market accounts, and there's also tax-free bonds. So there's different kinds that have different keys and characteristics. The thing that I want you to focus on is there's really three things that matter in bond land. One is maturity risk, credit risk, and then currency risk. So the two that really matter, and the two that most people really focus on, is maturity and credit. And some people will take currency risk, where they'll buy bonds that will be denominated in another currency. So what's currency risk or maturity risk? Maturity risk is the risk that you take that interest rates may change before you get your money back. And so here we've identified short-term bonds, which are 1 to 3 years, mid-range, which are 4 to 10, and longer term, which are more than 10 years. So it just depends. Now, the longer you loan your money out, what do you think you get? You get a better interest rate. So bonds are this thing that everybody kind of thinks in their mind are safe and stable, but they have these two elements called credit and maturity to them that actually can change that equation a little bit, and you can take a little bit more risk and get a little bit more yield. So graphically, we show you this is the relationship between bond prices and the movement of interest rates. And so as interest rates go up and down, the value of your bond will also change in value based on that movement prior to when it matures in value. Typically, a bond is issued at a particular price of, let's say, $100,000, and it will mature at that same price at $100,000. However, based on the changes of interest rates and this movement, the value of that bonds will change if you need to sell it prior to its maturity date. And so here you see the wheel and you see the pendulum, or the teeter-totter, and you can see that those interest rates movements and the value of those bonds movements are going to be directly related to how long those maturities are out there. And so what has interest rates done over the last numbers of years since the early late 70s, early 80s? Interest rates have gone down dramatically. So that has really fueled a very significant opportunity and environment for bonds, because they've increased in value as interest rates have gone up in value. The problem and the challenge that we face today is we really have two sides of the allocation. You've got your safe assets, which are bonds, and you've got your risky assets, which are equities. And you got to have a certain amount of money depending upon where you're at in your life and your goals and everything that we talked about in safe assets. But given where interest rates are today, they're almost zero. It's very difficult to invest in those types of interest rates where you're almost guaranteed to not make money, and when you factor in taxes, inflation, more than likely you're going to lose money on a going forward basis. So how do you deal with that? So we're going to answer that question. One of the ways that you can pick up additional return is you can take on credit risk. You can buy bonds of companies that aren't government bonds. They're lower rated bonds. And so this here in front of you is the credit scale. And so everything above triple B is what is called investment grade. Everything below that is called high yield or junk. And so not that either one is good or bad, they just have different characteristics associated with them. Well, they will constitute different risk reward profiles that when mixed together with one another, they will add into the portfolio in a way that can help you get to where you want to go. So really in the Bond 101 summary, we really just talk about the two things that you're going to focus on is interest rates and credit. And as you build your bond portfolio, you're going to have really three things. You're going to have the strategy that most financial guys will talk about is it does pay to extend your maturities into the mid-range, into the 5 to 10 year range. And it also pays to take on a little bit more credit risk depending upon what environment. But we give you a little bit of caution and consult with your guys to make sure that you are taking the right amount of risk that you think you're taking in order to get the necessary level of return that you're looking for that accomplishes what you're doing. Next, in this final section before we bring on John, is just stock return. So really what we're going to identify here, and we bring up our quote, is that, listen, the stock market is just this vehicle for taking money from the impatient to the patient. And so, look at Warren Buffett and look at what he says. I mean, he's just the master, and he's just well respected as probably the most significant and well-respected investor that is out there. So stocks have done 10%. So what I'm going to talk about, and I'm going to talk about it from an academic sense. Most people are just obsessed with how they can find opportunities that will do better than the 10%. My daughter Tatum is in an investment class right now, and she's created a portfolio, and the goal is we got to beat the other 40 people that are in the contest. So we want to do better than the market. We want to do better than everybody else. So I'm going to tell you how to do that from an academic standpoint, not from an opinion standpoint, but from just a pure academic standpoint. Now, stocks are really divided into two very distinct categories. There's growth and value, and you can sort of logically kind of know what they are. I mean, growth is when companies have a high price to book ratios, and value is very low. So, think about a company like Amazon or technology companies that are growing very rapidly. People have an expectation that you should pay a premium for those companies because of the growth that's in front of them versus slower and stodgy companies. So we divide these really into these two categories. So if we look at the premiums, and when I talk about premiums, I'm talking about, can you invest in the markets in a way that you can get better than a 10% rate of return? So before all this academic research was done, they really said, let's just buy the market and you'll get the 10%. But then they discovered something early on back in the 80s that basically said that size matters, that small stocks do better than large stocks, that if you buy a disproportionate amount of small stocks than large stocks, you're going to have a better return than 10%. And then they noticed something else, that value stocks, and I know you're shocked, that value stocks does better than growth stocks over time. So if you have more small stocks and you have more value stocks, you'll do better than that 10%. And then the last thing that recently came out is stocks that make more money. Imagine that. Stocks that are more profitable do better than stocks that are less profitable. So when you begin to look at these premiums, you begin to kind of look at them in a way that, wait a minute, if I craft my equity allocation to take advantage of these three things that I identified, I'm not looking at economic activity, I'm not looking at what Jim Cramer is going to say on CNBC. I'm looking at actual hard historical data and how I'll do. And what will happen is you'll do better than the market, or you'll do better than the indices because it's been proven. So it's incredible that right before your eyes, we talk about these premiums. Now here is a whole bunch of data on all the different markets. There's large markets as the S&P, there's small, there's international, there's reach. So you can measure everything. There's a market that will tell you how things are. Well, let's put this slide, and if you can go full screen with this so everybody can see it. It just shows you the data. And I was reminded by Tiffany that the people that get the slides are what? Are the VIP, and there's a code that she'll send you. Okay, so we got that done. So what we can see with US stocks, and we look at just company size, we minus small versus large, and what we're up to since 1928, that small stocks have done better than large throughout history. And then we look at it from different time periods, and each one of these time periods, we see these premiums for US stocks, developed, that's international, and then emerging markets. So we really analyze it and we go, look, these premiums are golden throughout all the markets. And we look at this. And then we say, okay, let's look at 10-year periods, and let's look at the three premiums. We look at small versus large, we look at value versus growth, and then we look at profitability. And so what you see, the red is when it doesn't work. That means that large outperforms small. So if you were to go to, let's say, Vegas, and I were to tell you that there's a gambling table that 80% of the time you're going to win and 20% you're going to lose, and there's another table over there and you're going to win 20% of the time and you're going to lose 80% of the time, what table would you rather be at? The thing about these premiums is they don't always exist. They don't always happen. These are rolling 10-year periods. So there's lots and lots of data about there's times within the markets that large do better than small. Growth does better than values for long periods of time. However, it would be incredibly next to impossible to know, okay, I'm going to be a value investor now and a growth investor tomorrow. It's impossible to predict those shifts in cycles. They just don't readily let you know when they are there. So what do? We just have to be allocated in a certain way. So we have a question.
The question is premiums, question mark, not clear from the chart, please identify.
So the premiums are the amount of outperformance that value has over growth. These in this chart here are the numbers, just the pure numbers. So if you look at company size, the premium of small to large is about 2%. The value to growth premium is about 3%. The high probability or profitability number to low profitability is about 4%. So you see those premiums, and they are a little different between US, international, and emerging markets, but they exist during these time frames. these charts here are just showing you the frequency of the outperformance. So most of the time they're captured, these premiums are captured. And then you look at it from a 10-year period. When you see the red, that's when large stocks did better than small stocks. And then you look at it here on this slide for emerging markets. You see that consistency, and then you see it from U.S. stocks here. You know, the one thing that we look at is we look at value minus growth, and let's come into the real world. So if you've been a growth investor, relative to value, you think that I'm on medical marijuana or something because the premiums haven't been there. You know, the last 10-year period, large stocks has outperformed small has underperformed, and growth has significantly underperformed value, and it seems like there's no end in sight for the cyclical rotation. There's a lot of people that talk about that this is going to happen, and just be patient. The process of being a disciplined investor is we're not investing for the next 5 to 10 years. We're creating an investment plan for the next 30 or 40 years. And if it's multi-generational, it's the next 100 years. So these premiums are going to reverse. Growth is going to underperform. Value is going to outperform. Small is going to outperform, and large is going to underperform. It's the nature of these premiums. It's the nature of, historically, how these markets have worked. Now, there's been a bunch of articles about the death of value and the death of small cap, and I don't know. I don't know how to weigh in on that data. I remember a lot of the things that people said in 1999 and 2000 about how you didn't need to own a value stock anymore, that all you needed to own was growth stocks because of the internet and all the things that were happening. And I'm not saying it's the same. I'm not saying that it's deja vu, but what I do know is markets rotate. And when you think something's working, turn around, because it's not going to work in the next environment. So part of the process to become disciplined, recognize that these premiums are here. They're here. It's just how they are. They don't always exist. There'll be 5-year, 10-year periods. But what happens for people, and that's why we spend so much time in this class on the emotional side of what this is, because if you're not focused on the discipline of how to invest, you're going to say, you know what, I went to that sustainable class. I invested like they talked about. I met with my guy. I bought this value stuff. It's been 2 years and it hasn't worked. I'm going to flush it, and I'm going to go to the growth guy. Because you're going to always have somebody in your ear. You're always going to have somebody else that's going to try to lure you over to their side of the street. It's going to go, oh my God, I can't believe that you don't Amazon, Apple, and they're going to create these stories that tell you that you're doing the wrong thing. And if you're not focused, and you're not disciplined, and you're not firmly entrenched at what the mission of the family is and what the mission of the investment account is supposed to do, then you're going to make a change. And so where did we talk about that the key to everything was to have the best performance in the next 2 or 3 years? You're fulfilling an obligation to yourself and to future generations that you may not have the best account in the next 5, 6, 7, 8 years. That's not what we said we were going to try to do initially. We were trying to create consistency. And by creating consistency, we're going to have a framework by which you're not always going to be the top dog. But what that allows you to do is that allows you to equalize. And then when it's working and you're doing phenomenal, you just don't get too excited about that. You know that it's going to change at some point. Mike Mackin is just a classic example. He adopted, this rules-based approach. And so, again, we have these premiums, and we have these charts that we look at, and and then we look at the 5-year data. This is 5 years, and it doesn't look as good. It's not as clear about what you should do. So when we condense the shorter periods of time, you know, these premiums don't show up the way that they do over a long period of time. So we overlay the person, we overlay who they are, we overlay the discipline of what it is that we need to do, and really how we do it. So that's really where I wanna leave you for tonight. You know, it's that here's the academic premiums that, look, stocks are risky. They go down really fast. They went down 30% in, I think, 21 days. They went down faster than they'd ever been, you know. But yet what's happened, they've also come back. You know, had the best week that I think they had on record. And remember, it's about keeping you in the game. It's about creating an allocation. It's about exploiting the academic data that's out there in a way that you can take advantage of that's not opinion. That's where we're at relative to the premiums.